Hi, my name is Kim Evans Brown, and I'm a second generation producer of poultry and equine. I've been doing taxes since 1982, a former IRS agent, and decided that I wanted to represent the people. I also have a legal background and work a lot with tribal producers and small business, small ag operations.
Okay. My name is Darrell Tennie. It's an honor to be here with Ms. Brown today with the Tennie Agriculture Group. Okay, as well, today we represent our nonprofit called Farmers Outreach Solution. Okay, also we're Agribusiness Crop Insurance Group. I am a crop insurance agent as well. So our tax accounting firm, we work totally on agribusiness development. One of the things that we want to do, we want to make sure that our farmers understand agribusiness. As we say, we may have to redefine the word agriculture and define the word agribusiness. And we work with our farmers on entity structures, payroll, financials, and the whole aspects of an agribusiness operation. Okay, I spent 20 plus years in corporate America, and one of the things I saw was that no one was educating that to us. And so that's why we have a trademark on the word, the agribusiness way. Our goal is to build agribusiness across the country. We're farmers across the country and the territories, and we'd love to have opportunity to work with you as well.
Thank you. Darrell, this question's for you, but what kind of resources do you have available for producers who receive these payments and are curious about the tax burdens of these payments? What kind of producers, or what kind of resources have you published?
Okay, well, we have a lot of information. We actually are in the process now of putting together our director here online on curriculum training development. But for a resource perspective, we have a whole building, two-story office building there now that we have a financial department and a tax analyst department and a payroll department. But from a resources for the DFAP, we have a whole team that we work with that has opportunity to show us how to receive those DFAP payments, but how to reduce the taxable income off the DFAP payment. Okay. Those are things that we're trying to bring the resources of the technology, technical system, in how to reduce those payments or how to offset those payments.
All right, I got another question for you because you were on the first one.
Okay.
Can you share a brief overview of the DFAP program for our participants here?
Well, the DFAP program is a payment that we receive, as they say, DFAP for farmers of discrimination. Okay, they kind of classify not discrimination, but this payment has been received by two farmers. Okay, but the farmers are going to receive a 1099 miscellaneous. This is going to be taxable income to farmers in certain situations. Okay, especially ones who are farming and who are not farming. But the one of the things about a DFAP payment, these payments it's going to be taxable. Okay, for your discrimination that from historically. But these are going to be a taxable event. But they are an opportunity to reduce taxable income or to schedule where it's not affecting you from a self-employment tax perspective. Okay?
All right, thank you. Kim, this question's for you. If this assistance is considered taxable, how should it be reported on my tax return?
So to be reported, it depends on the facts and circumstances of your farming operation and or your business. So everybody in here is going to have a different situation, but it can be determined or reported on two different forms. It would be either on a Schedule 1 or a Schedule F, depending on where your income is derived from and where your expenses are coming from. So I guess that's the best answer.
All right, Darrell, does the program payment count as ordinary income or as a form of compensation that could affect other tax filings, such as self-employment tax or Social Security contributions?
Yes. Okay. As Ms. Brown was saying, it's according to where you got it from. In most situations, if you're retired from farmers, and many people say, you could put it on that Schedule 1 and on line 8Z, where you don't have to worry about paying self-employment tax. But if you're a farmer, I will put it on a Schedule F so you can utilize the tax deductions of agricultural expenses. That will help reduce that taxable payment. Now, the remaining balance will be affected by self-employment tax, but as Ms. Brown said, the Schedule 1 will not. That's on line 8Z. Most time, if you are farming, you are going to put it on line 4A on the Schedule F. Now, will it affect supplemental payments? Yes, in some ones. I think they're saying that if you are, the entitlement is not supplemental will, but not entitlement. But yes, it will affect those benefits. Many have already been affected by those benefit payments plans. Okay?
Thank you. This is for this is for Darrell again. Are there any potential tax deductions or credits that could offset the tax burden of receiving the DFAP payment?
Yes. If you are farming, you absolutely want to use that Schedule F and the deduction within agriculture income and expenses, okay? Chemicals, land, conservation, as Ms. Brown has here. This is your Schedule F, as Ms. Brown is showing. This is your Schedule F. Utilize the Part 2 of your expenditures, but you got to keep good records now. That is where we have a lot of people ask all the time, so, well, I received that payment in July. I'm trying to get all my spends from July on down. Absolutely not. It's from January the 1st, the entire year. If you receive $100,000, but you already spent $30,000 from January to July, now you're looking at only $70,000 left to reduce. But also we advise people a lot of times, look at payroll. Look at payroll because payroll is a tax deduction to yourself if you're paying Social Security, Medicare, and unemployment. And that's an opportunity now. And a lot of people think you got to pay payroll on a specific schedule. As long as you pay within that year, that is a tax deduction opportunity. A lot of people miss now putting yourself on payroll. I didn't say draw. I say payroll. Social Security, Medicare is a payroll system. That is an opportunity to reduce tax income and paying in tax on your payroll.
You can also lower the amount of income if you receive the 1099, like Darrell said, for your award, but it cost you money out of pocket to receive the award. Sorry. So say you got a $50,000 reward, but it cost you $25,000 previously before you received the award, you would deduct that off of the 50 and you would only put 25. And that's where the Schedule 1 comes in, because it's going to, and you write a little statement and you attach the statement to your tax return where it says everything that's being deducted from your award before your expenses.
All right, thank you.
Yep.
How does the DFAP assistance impact farm or business entity structures differently from individuals? And are there different tax reporting requirements for entities versus sole proprietors?
Yes. Now, that's one of the things that we work with our farmers across the country. We want our farmers to understand the difference in the sole proprietorship and entities, okay? If you're an entity, it received the money, not you. It carries the liability, not you. But in this situation, a lot of most of our farmers are going to be receiving this 1099 individually, okay, as a person, as an individual. That's going to be the situation here. But as entity structures, and again, moving forward in the future, we want farmers, like I always say, it's not how much money you receive, it's how you receive the money. But we want your entity to receive the money in the future, not the farmer. And as Ms. Brown is saying, looking at what you put in, that could be your startup cost for beginners, or a loan to the entity, or a loan to the entity that has to be paid through repayment through shareholders' equity. So the difference is, individually, you're going to receive the money. But if you structure your entities as our partner, we have a whole department that does that, it receives the money, not you. And you only receive what you pay yourself from the entity. Now, you're going to get a K-1 form as an S corporation like that as well. But we want our farmers to understand sole proprietorship, a lot of times, is debt to the farmer or income to the farmer. We want the debt and the income to be received by the entity, not the farmer.
All right. This is our last question before we open it up to general Q&A with the audience, but what planning strategies or tools do you both recommend to mitigate the tax burden of receiving the DFAP payment?
My advice would be to keep records, detailed records of all your receipts and expenses, and expense everything. As a farmer, most people don't realize that you can expense everything.
And I reiterate that, making sure you understand your record keeping financially. One of the things that we do with our firm, we have a department that handles all your profit and loss, balance sheet, cash flow, tribe, journal ledger. We keep those records for those farmers. Our department runs monthly service for our farmers, but as Ms. Brown said, you have to expense everything because you're only going to pay taxes on what's left over. You know, we get a lot of farmers come in and say, I got this big DFAP payment, I got to pay tax on it. No, you don't. If you got good records, only what's left over. And I go back to that payroll again. If you pay yourself, you're going to pay yourself once a year. You don't have to pay yourself monthly, bi-weekly, bi-monthly. You can pay yourself once a year. We have farmers pay themselves at harvest time and once a year. But you got to keep good records now. That is the key in reducing those taxable income. As Brown said, the IRS is going to want to see those records, as you said.
All right, thank you. Do we have any questions from the audience? I know we have. Okay, great, thanks. I have to get you the microphone first.
Good morning, everyone. My question, I didn't catch the dates. When is the taxable time frame?
From January 1st to December 31st, that's your taxable time frame because you received the money this year.
Yeah.
And you're filing next year for this year. So anything from January 1st to December 31st.
Okay, because the awards were received by the recipients within 24, so that would be the reporting,
Yes.
not after the award.
No, the reporting, you received it within that year. But you remember now, you're operating from January 1st to December 31st. That's what we said earlier. If you receive the payments in July, a lot of our farmers think you got to wait from July on down to look for expenditure. No, if you've already spent money, as Ms. Brown even said as well, if you already spent money, that's going to affect that money you received. You just received it within that year, but you started operating as of January 1st. So anything from January 1st to December 31st of this year.
Okay, thank you.
Yeah, I had a question. I received a little bit of money from this program, and I built a shop, and I was wondering if I could use that as tax deductible to lessen the taxes that I'll owe on it.
Absolutely.
I had another question. I belong to a trust, a family trust. And my brother received money for this program in the name of the trust. Would that make me liable for his money he received?
Well, if the trust received the income, the trust will have to file taxes. Because the trust will really have to file unless they receive income. The trust will file taxes, okay? And also, go back to what you're saying about the building, as we were saying, absolutely. But you can also look at, a lot of our farmers fail to really look at depreciation. A lot of times you construct building stuff, we got to consider depreciation. Not only what you have built, but what you have, the equipment and inventory. So that's why it's good to keep good records, because a lot of our farmers undervalue themselves because they don't have all their inventory and assets on their balance sheet. You have to have the information on your balance sheet, because when you make payments, you can deduct the monthly payments on like vehicles, but once you make a payment, it reduces a liability on your balance sheet, but increase your assets. But you got to make sure you keep complete inventory so you can utilize depreciation on a lot of those equipments.
First, he said. Yeah, that's one question.
My question is, when I was reading the DFAP information, it basically said this was reimbursement to the individual who got paid. So I was confused when we were told that the taxes were due. So my understanding is, if this is reimbursement, how do you work with that? Because we do already keep track of all our expenditures right now. We have a big book of it.
Right.
But we didn't pay ourselves, and we still have some money left. So how would we be able to, tax the rest out?
So from an IRS standpoint, the reimbursement is wording. It's part of the way that the federal word things. So you were received an award, you filled out forms and paperwork to receive that award, so therefore you won the reward. So therefore you were reimbursed for your lack of whatever. So looking at the word reimbursement from a tax point of view, you shouldn't worry about that. To answer your other question, you want to pay yourself, take those expenses off of the money that's left, and hopefully bring it down to where you will not be taxable.
Okay.
Yeah.
Oh, you also mentioned a deal about, I mean, you said something about you can, now I'm forgetting what it was. You said you can claim certain things to bring down your taxes. What can you claim?
Everything.
Everything. Okay.
Yes. So say you needed help with filling out the forms for DFAP and you paid a financial institution to help you with those forms. Those fees get deducted from your award.
Okay.
Then all your expenses after you received your award and before you received your award get deducted off of what's left,
Okay.
as well as paying yourself an owner draw.
Okay. Thank you.
I want to add what Ms. Brown said and stuff. Refer to that Schedule F, okay? That Schedule F has those categories on it. But if you don't see that category on it, write it down. If you bought a refrigerator, you don't know to put refrigerator to $100. But as we've been saying it very clearly, pay yourself. A lot of performers can pay themselves, but I would advise you to pay you through a payroll system, like an ADP or whatever. We have a whole payroll department. I'm not saying it. We love to serve you, but we have a whole payroll department. Because when you're paying yourself, you're paying your Social Security and Medicare. But if you pull it as a draw, you're going to get a 1099 again to the income you receive. Anything over $600, you're supposed to get a 1099. But if you pay yourself through a payroll, you're paying in Social Security and Medicare and unemployment as well. But you're paying in taxes on that already. So possibly refunds could be an opportunity once you reduce your adjusted gross income. Once you do your adjusted gross income, a refund could be a possibility now. I didn't say we were going to get a refund. I said it could be a possibility based on your adjusted gross income. But if you give yourself a draw now, people, please, you got to pay tax at the end of the year. But if you pay yourself once a year, you're going to pay Social Security Medicare, you can get a check stub and a W-2 at the end of the year, but you've already paid in taxes, okay, on that amount, okay?
And just add to that, a lot of people think that when they pay self-employment taxes, that's a bad thing. Like, oh my gosh, I don't want to file those. But that is your unemployment, no, your Social Security and Medicare. So when you pay in on a Schedule SE, it's for your Social Security later on. If you're always in the red and you're never filing a Schedule SE, and then all of a sudden you find yourself needing Social Security, you will not have anything to draw from.
And that's why you want to pay yourself through a payroll,
Yeah.
again, so you won't have to worry about the SE and you won't have to worry about the self-employment tax. So you pay self-employment tax when you're giving yourself a 1099. But when you're giving yourself a payroll, you're paying in Social Security, Medicare, and unemployment. Okay? And again, you've already paid, that is your taxes. So you don't have to worry about estimated taxes. Your payroll is your taxes you're paying in. Okay?
Okay, thanks for being here. I have a question. I put myself in a really hard place between two rocks, I helped the analytic acquisitions here do outreach for this DFAP program, and I have a lot of the people that I help calling me about the taxes. Can they contact you guys to have questions?
Absolutely.
Okay, and
Absolutely.
because they're asking me what percentage of it has the liability to be paid taxes? Is it, 30, 15, 12? And I couldn't answer that.
Right.
What's left over?
And every circumstance is different.
Yeah, that's what I told them
Yeah.
after reading into some of that information on taxing. So the question I have is that through this calendar year, all your expenses that you've spent on your equipment purchase, your tractor tires, all your parts breakdowns, that could be reported into the taxes to offset, try to offset, because there were some happy people that got $500,000 when we helped them. And, they've, the question to me was, if we spend about 30% of that, are we safe to offset the taxes on that? Is that, and I couldn't answer that. I said, no, I'm not going to answer that question. Is it?
The answer is yes, but many times it's what you are buying, okay? It's what you are buying that will qualify as a true farm expense. Now remember, you're receiving some money as 1099, okay? You can do whatever you want to do with it, but as long as it's being utilized as a farm or business expense, here we're talking about farming, yes, it will absolutely reduce. But what we educate our farmers on is this. A lot of times, don't go out here and spend the money. People say, what's the first thing you should do? Put your credit report. They always tell everybody to reduce your personal income. So now, utilize this funding. You might want to go out and utilize operating lines of credit. Why? Because you're keeping that money in the bank, but if you have operating line of credit, you use out the credit. Even if you're spending the money off the operating line of credit, the expenses goes to the money you receive. So that money is still sitting in the bank, but you're using the operating line of credit, it's going to reduce that money because of the expense that you paid. But again, that money you will spend, if it's a line of credit, once you make a payment back to it, it comes right back to you on a line of credit. So we're telling farmers, don't go out and run and spend 30%, seeking you get an operating line of credit, spend that money, leave that $500,000 in the bank, because when you spend $300 off the other credit line or $100, you spend $70,000, it's going to offset the $500,000. Now you only tax at $430,000 because you're using those expenses, but you still got your money in the bank. So if you want to go buy something, buy it through a line of credit or finance and not that money. We have a lot of farmers around this country. We serve farmers around the country, around and the territories. Everybody's trying to spend their money. Whoa, wait now. Don't rush and spend the money, your money. Utilize a line of credit and keep your money and spend the bank money or their money. You still can use those expenses to offset the money you received.
And anything that you buy that carries an interest rate, you can write off that interest.
So to that question, the IRS knows exactly what this money was sent out for these individuals that got that work.
Mm-hmm. You got to show them, they know you're going to get a 1099. And a lot of people understand, as the question asked, we get all the time say so-and-so, they are legal tax deduction. We get people come to us all the time say so-and-so say they can hook me up. No, they can't. People come to us so hooked up, so like we can't get them unhooked. You don't need to get hooked up now. There are legal tax deduction to reduce taxable income. Their Schedule F is your first start. Please stop letting people tell people you can reduce these taxes. I tell people, this is a taxable event. We don't want you to be spending next 10 years trying to get out something you could have did in 1 year.
My question kind of goes back, probably piggybacks onto that, where a guy built a barn or something. If I had an expense this December, but I don't physically take possession of it, like if I paid a contractor to build me a barn, but it's not going to get done until February, or if I buy a tractor and I ain't going to get physically hold of it until February, is that still an expense if I pay it within this year in total?
Yes. Yes, that is an expense. But when you bought that tractor, whenever the date you took possession of it, that's when you start your depreciation, okay? Any money you spent in this year, down payment, whatever, that is an expense for this year, even though you're taking possession of next year. But anything that is a capital expenditure, you want to continue to keep the depreciation on it. You can't take the payments on the P&L, you got to take the depreciation on it, okay? So the answer is yes.
Hey guys, I got a simple question. We bought a farm back in 2008 and never filed a Schedule F, and we did receive some of that funding. So you guys keep saying January to December of this year. If we don't have that expense yet, can we still file it on the Schedule F?
So you bought a farm in 2008
Yep, we paid it off about 2 years ago.
and you've never filed a Schedule F.
Never filed one.
So what do you file on your tax return?
Just just a regular tax return,
No Schedule C?
no Schedule C.
No business. Do you make income from your farm?
I do. It's probably about $10,000 a year we make off of it.
Yeah, so, yeah.
I would advise you always to file a Schedule F, okay? Always. And you can always go back and do an amendment now. You can amend a tax return. But if you received a farm and you're farming and you never filed, any type of agricultural operation, the one form you do not use is a Schedule C. Do never use a Schedule C, okay? But I would advise you go back and refile. If it's worth it, file the Schedule F. From this forward, you moving to Schedule F. But I would advise you to create your own entity. We highly recommend create limited liability companies. But you got to understand now, when you create an LLC, it has three ways to file: sole proprietorship, partnership, or as a corporation. How do you determine that? When you apply for the EIN number. That's how you build that foundation structure, that EIN number. If you're a sole proprietorship, you check from an LLC, a single member, that's a sole proprietorship. Multi-member is you have to do the 2553 to get your S corporation elect as a tax as an S corporation. You got to file it within 75 days of your formation.
I had a question about, you talked about the EIN number, and then if you're trying to establish the business credit side, how did the SAMS number change? Because I know it changed and the process is a little bit different when you're trying to get business credit and not use it in your name to purchase things like equipment and those types of things. What was the difference? Why did it change?
Well, the SAMS number basically is a lot used for a lot of government programs. But I tell people, when you apply for your EIN number, when you're going to apply for equipment and stuff, apply with the commercial application. Do not use an individual application. Because once you comply with a commercial application, and once you structure your entity, make sure your entity taxes the corporation, you sign on behalf of the company as a guarantor and not a co-signer. As a guarantor, it doesn't show on your credit report. But again now, you're a guarantor. If the company don't pay for it, they're going to come after you. But anytime you have entities, you have an issue with situation problem, you can always close the entity, transfer the asset, and start a new entity, okay? As a Social Security number, you can't do that. But when you're applying for business credit, apply with a commercial application. You don't have to, I really don't want to recommend a SAM, not saying you have to get a SAM number right now, but you just need a commercial application. The DUN number, the SAMS is basically, I think, a lot of government programs. The DUN number is used when a lot of like the Walmarts and the Targets and stuff like they use the DUNS number. Now, there's some programs want you to have a SAMS and a DUN number according to what you apply for. But for most of in your agribusiness operations, you may not need that DUNS or that SAMS. You need that EIN number structured correctly as an entity, utilizing the 2553 to make sure it's being taxed as an S corporation, separation from yourself. So when you apply for that commercial, you apply for that equipment, it's in the entity name, not your name. It carries responsibility, not you. The assets are on the entity, the debt is not on you, the individual, it's on the entity.
So just asking for a couple of people, I've heard of some folks that applied for DFAP under their entity or under their company's name, but the payment came to their individual. What would you suggest to folks that's happened to?
What I would suggest, that was a problem because we have a whole department of structural entities across the country and the territories. If that happened to you and you receive it in your name, you want to utilize all legal tax deductions now to offset that income, okay? Even though it came in your name and you file on your tax return, you still can utilize legal expenditures of agricultural expense to reduce it. It's just that it was received in your name, not the entity, okay? Again, one of the biggest things we advise people to look at putting yourself on a payroll one time away, it can be fine, but we have to still utilize all legal tax deduction and who is operating. It's going to be difficult for a lot of people. I'll be perfectly honest with you. A lot of people are going to receive that because we got farmers calls all say, I got an entity, we actually educated them on, but it's in my name. But we still going to have to use legal tax deduction from your personal side to reduce those tax income.
So just to add to that, the EIN number is attached to your social security number. It is attached to you. So when the IRS gets a form that has your social security number and your name, that's how it's recorded. If you have an EIN number and it comes in with your name and your EIN number, and I type in your EIN number, your social security number and name comes right up. It's all attached. So to answer your question, the 1099 comes to the person's social security number, but it's going to be attached to the EIN on the paperwork. So I hope that answered your question.
Yeah, I'm gonna go back to the EIN number. Like she said, all EIN numbers are attached to your social security number, but it's the filing requirements of the EIN number. How do you structure the filing requirements, selecting when you apply for it? Again, like I said, it's gonna come to the social security number, but because of that, it's being taxed to the individual, not the entity on this situation.
So because the DFAP was tied to FSA discrimination, and you use a portion of that money to pay off an FSA loan, does that reduce your tax liability?
I believe so, yes.
Yes, it's according again now. How much of that money did they give you on, how much that money they gave you on the 1099? See, in certain situations, say, well, you paid it off, or you got $500,000. So you paid off 200, we only gave you 300. But if they gave you the whole $500,000, then we got to go back and look of what they paid off and what kind of documentation shows that it was paid off. Now that's a major issue again as well to a lot of our farmers, okay? Showing that expense now. What did you receive on the 1099?
And for, again, facts and circumstances come into play. So say you applied for the DFAP and was denied, and then went and got financing through another organization that has an interest and has things, and then all of a sudden somebody says to you, hey, you can apply for DFAP, go and get it. You apply and get it. Now, if you have records to show, I applied for this and was denied, I was forced, basically through discrimination, to have to go this way. Now, all those expenses are taken as deductions on the money that you received.
I have a question. There was a question here.
I had a question, and this is for, I represent farmers in the New Mexico San Juan River area. We have a lot of farmers that did apply for DFAP. One of the things is we had a slew of lawyers come through the area and say, we can get this money for you, da 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 da. And a lot of them did apply with those lawyer firms. But the catch was, before this DFAP came along, we had a Gold King mine spill in the San Juan River, and the same thing happened. We had a slew of lawyers come in and have the farmers apply with them. But in that situation, the lawyers changed hands and they dropped the ball, and a lot of the plaintiffs that signed on with the law firm got left out and never received any kind of compensation, and the time had lapsed. And then so when DFAP came around, the same people that applied with the law firms, they didn't hear anything after they applied. I mean, it went on for months. Right. They kept calling, where's my case? What's going on? Do you need additional information? So until that deadline, that day, they never received anything from that law firm. So what they did was a lot of them applied, directly, because they found out, oh, we can apply by ourselves. So that's what they did. Later on, and they got their checks. And later on, the law firm came back and said, oh, you owe us this much because, but then they were like, we already applied because we never heard from you. And we got this number from the government that said, we applied and they were paid their checks. But I think the law firm just gave up and said, well, I guess we didn't get the money for you. So we're not, but a lot of the elder farmers, they're on disability, they're on these, retirement things, but they did get money and they're wondering, is this going to affect our disability getting this extra money? So that's kind of where they're standing at. They're asking questions. So that was one of the things because they're limited on disability and they don't have, they don't file taxes on their farms because they're afraid that they'll lose their disability from the government because some of them receive like 25,000, but nobody received $500,000. They were probably wishing they would get $500,000, but their operations were like 10 acres or less. So that was the question that they had. I just want to know if that's going to be, if you have any answer for that.
Well, yes. If they receive any monies and gonna get a 1099, yes. But now you mentioned that many of them receive small amounts. Small amounts may not affect your disability. Small amounts may not affect, because you can make up to a certain amount of tax without affecting your disability supplemental. But from understanding, this program only going to affect supplemental programs, and some entitlement program it won't affect. It's just the supplemental programs and stuff, disabilities and stuff like that. Okay, but they need to file now. The problem if they don't file it, if they over the limit of what they don't have to file, they may face a tax liability in a letter. We've heard that story all across the country where lawyers, are taking advantage of a lot of the individuals now. I'm not a lawyer. We have lawyers work with. I think we saw him have an attorney in the room here with Sarah Holmes was in just now in regards to what can be done our attorney. We have to consult an attorney with that. But now, let me tell you about that as well now. Those expenses associated with attorney is a tax deductible fee now. If they pay an attorney, that's a tax deductible fee. Not saying it benefits from, but yes, many people didn't know they could file on their own and get that money themselves. But that money spent on attorneys is taxed up. But I would get an attorney to refer in regards to what was owed or was not owed to a legal team. Okay? But again, we want them to file those taxes if they have to. Look at their limits on what they receive. But please, they need to file that 1099. We got one question right now.
Hey, yeah, I just wanted to raise one other point. Maybe it was two other points. That you can deduct all the expenses that you paid the attorney.
Yes. Mm-hmm.
And then, so to remember that. So if you had to pay him but also, what are the rules and limitations on purchasing supplies and other equipment for the next farming season before the end of this year?
Now, for the next farming season, as long as those expenditures are carried in this year for next year, that's fine. Now, you won't have to spend it next year because you claimed it this year. But again now, if you're spending money by December 31st now, for next year, you can claim those expenses within this year. Just like I'm saying, Jim back here, if you buy a piece of equipment for this year, he can claim the expense of what he paid out of pocket, but his depreciation going to carry over the life cycle of that equipment, whether it be 5 years, 7 years, 10 years, whatever. That's going to determine his expense in that aspect of it. Now, yes, all that going to be claimed in this year. Now remember now, but you take it this year, you can't claim it next year. You can buy more, but you'll be claiming that expense in this year. So what she's saying is absolutely true. Absolutely true.
I have a question. When you buy livestock for your farming, will that also go into equipments and stuff like that? Your livestock animals, like horses, you buy horses and then bulls for your livestock. You can get tax deductible on all that.
So when it comes to livestock, it depends again on the facts and circumstances towards that livestock. If it's livestock that you're going to purchase and grow within that year, and then you're going to earn income within that year, then it becomes something that goes on the paperwork in that year. Breeding stock is different. Things that you're buying you know, if it's poultry and you're buying chicks and you're keeping them for 2 or 3 years, then you want to find out the life cycle of the bird and you want to take it off for that amount of time. So livestock can be complicated.
Yeah, because we just purchased about 15 head of bulls for breeding, and that's why I was asking. If you say that if it's a purpose for breeding all that, it takes a whole year. Okay, so after a whole year, can you can still get a tax deductible on that or what?
So you deduct the life cycle of the animal. So for instance, if you have, I do poultry. So if I have a hen that I'm going to have lay eggs and she lays eggs and I sell her eggs over the course of 3 years, which is usually how long we keep them before they turn into another form of livestock on our farm, then her worth goes down as she gets older. So it's the same as depreciating a tractor or depreciating a car. So you're going to say that that hen, if I was to sell her at auction, is worth this, but now she's 3 years old, she's worth this. So each year when you look at how many hens you have and what they're worth, you have to take into consideration their age, what they're doing. I would think that cows would be the same. I know with our horses, our breeding mares, depending on what their foals are selling for, some of the breeding mares are worth more than if they're just breeding. So it depends on the facts and circumstances of the animal. Yes, you can write them off, yes. And if you have one that you get as a young calf and you're going to grow it for a year and then sell it, then I would take the cost of the calf, the amount that it costs to grow it, and then what you sold it for. And if you made $500, all the feed and everything comes off that $500. So maybe you didn't make anything. Does that make sense? I hope.
Yeah, that animal is deductible, period.
But yes, it
And
is.
especially you said one keyword, breeding. All right, that's like an appreciation because it's breeding.
Yeah.
It's appreciation because it's breeding.
I hope I answered that right.
Yeah. Yeah, because as long as it's breeding, it can be appreciated as breeding.
Yeah, I just thought I'd better bring this up because this is a situation on my reservation. This goes back to the Keep Seagull settlement when awards were given out to producers. A good many of them were elders that no longer farm or ranch. And so some of them, knowing that a 1099 was coming out the following year, had to file taxes, but never filed in their lives, and so just flat out refused to file. And nothing happened. No IRS didn't come after them or anything. So the same situation applies here, where so and so did file on their Keeps Eagle settlement and now receiving a DFAP payment. Said, well, nothing happened to so and so back then. Why should I file this time? So, what are the implications if they don't file?
Well, I'm gonna ask if they don't file, they possibly. But again, now, is it reservation? Is it trust according to how it's depicted as how that money is received on the reservation? I think if they're tax exempt, a lot of money for the reservation. So again, it's how and who received that money. And in the Indian land, was it on the tax trust or on Indian land? That's all. Like she said, it's all about an individual. We got to look at that aspect of it. Now, in some situations, now I've had experience where they thought it was not taxable because of it, but it was. Okay, in certain situations, we've had that situation working with tribal communities. It was taxable. So we got to identify now: is it taxable or non-taxable? And again, going back to Schedule F. And utilizing that, is it tax exempt or do you put it on Schedule F as in line A as individual, but line B, 0 as taxable? These are all things we have to look at. Okay? That's why you need to fill out Schedule F correctly. Okay? We had to look at the individual. Okay?
first. Yeah, and then I'll get to you.
I'm starting up a poultry business, and I purchase feed for my chickens. So I'm assuming I can write that off when I start my business.
Yep.
But I also have horses and pigs, and can I write that off as well? The expenses for my horses and feed.
Ye-
If you derive income from them, yes.
Okay, thank you.
So my question goes back to the receipts and stuff that we filed was when my father was alive and my father was the operator of the ranch. The payment went to my mother, who and actually inherited it. So I guess we're trying to figure out with the estate and all of that kind of stuff going on, how complicated this is going to get. Because again, she's technically not the operator. My nephew's the operator, but she received, technically she received my dad's payment that he would have gotten if he was still here, because he was the operator at the time and the owner. We used his document to file for the payment. So any advice of how we handle that?
She is going to have to file taxes because the 1099 went to her name. She's going to have to file taxes. The 1099 went to her name.
Okay.
She's going to have to file taxes.
So my concern is she's not going to have all these deductibles, you know, because again, it was my dad who was the owner and operator. I'm going to say this was a while ago. My dad's been gone 8 years. And so we filed, we used the documentation because that's when we had the loan issue with FSA, was back then. So that my concern is that she's not going to have the deductibles because she's not the operator of the farm now.
Well, and Ms. Brown can address this as well. As I tell people, this is going to be a taxable event, okay? She may can utilize the schedule, the schedule 1, in which she may not face self-employment tax and put it on 8Z. She may not have to utilize Schedule F, but if there's anything that she can utilize as a legal farm deduction, utilize Schedule F, or she may have to do the Schedule 1 online 8Z, if I'm not 8Z. Okay, that probably was her big. And I'm telling people all the time, this is going to be a tax event for many people because they are not utilizing or they don't have legal farm deductions right now. Okay, so any other?
Yeah, to add to your question, I've had some experience with that situation, and from an IRS standpoint, I would speak to someone who has experience with that, but you want to document everything, and if you can show that the information came from your dad, who then passed, so you have a death certificate, who then your nephew is the one operating it, but then DFAP gave the thing to your mom. If you can show it all and document it all, the expenses for the farm would come off of the DFAP because the farm was used to get the DFAP. So as long as you can show it all and have all your paperwork documented, I would attach that to any forms, any IRS paperwork that you're sending in. You know, write up something, write up a letter, and add it all and explain it. Maybe you have to do it through your trust. Maybe you have to do it through however your facts and circumstances are. Yep.
I have a question about gifting. Like if you gave a donation, whether it's to school or somebody else when you're helping, how's that written up? Can it be written up?
Yes, contributions can be written off. It again goes back to facts and circumstances and what kind of organization and or situation that you're donating to, and keeping your records.
Going back to my last question, I make about $2,000 a year off of showing my horses. And so how do I deduct that? Because I spend more than $2,000 a year on horse feed. So how would I work that? And I'm asking on behalf of rodeo cowboys who make a lot more money than I do going out to the Indian rodeos and PRCA rodeos. I'm kind of asking for them too, because that's interesting, the situation.
So if you derive income from any livestock, and you're going to put that on your Schedule F, then anything that is an expense for that livestock, you get to write off, and it defers the income. So the farrier, the vet, your worming, you're going to go to a show and you need a new saddle. Document everything. Make sure that you show that your other saddle broke or maybe is worn and not safe. Make sure you document and write down everything. But yes, you can write it. Yes.
When you conduct a business, like Ms. Brown said, document everything. When you conduct a business, always have a separate business bank account. Never commingle funds. That bank account, that bank statement is your documentation. Okay, like I said, write it down, but that is your documentation. Never commingle funds, but as you're saying, all that is tax deductible. All that's tax. But just remember, open up a separate bank account, never commingle funds.
Question. That was loud. Can we defer half of the revenue to the next year of the payment that was made to individuals?
Yeah, it was dependent on receipt, but normally a deferment is a qualifying deferment. A payment. For example, crop insurance. I'm a crop insurance agent. For qualifying factors, you receive this, I can defer it the next year. But in most situations, like you said, it's according to when received and how it's received. Do it qualify for deferment? It has to qualify for the deferment, right? It has to qualify for deferment. You talking about DFAP payment? Yes. I'm saying no. No, the DFAP payment is not going to qualify. That's why we have to tack out this year. And like individuals who receive, funding, as you said, if you got any receipts possibly that can utilize that you have someone using in the past, but this is not going to be deferred. This is not going to be deferred.
Can you raise your hands in the front?
One thing that comes up a lot with the farmers that we do is to keep a little book in your car, like if you're going to make a donation where you write down all of the mileage and why you count the mileage deduction instead of the gasoline for all of your trips. And then also when you keep your receipts, you know that on this day you went here for this place, but it'll help you remember all of those things.
Because miles versus receipts, basically, you get what, 58.6, if I'm not math right, it changes every year. You get so many per mile. But a lot of farmers, because they fill out these big 3500s and stuff like that, they use, it's according which benefits you the most, mileage or the actual receipt. Okay, mileage or actual receipt and stuff. That's another qualifier, okay.
All right. I think we'll wrap up the session today just to be mindful of time. We're going to head into the lunch hour, but I wanted to thank our panelists here and just let them leave off with how to get in contact with them if you have any more questions.
So I did leave some business cards out and about and handed them to some people that were here early. I have extras if you need them. We travel, my daughter and I travel all over the United States, and I represent people in all states. So I'm available if you need me, just give me a call.
We have we gave us some bags and stuff. Tennie Agriculture Group, we represent today our nonprofit, but you're more than free to please give us a call. We have a whole departments there. My personal number is 919-279-7148. But in our bags, we have all the information that you need to contact our office, okay? And we look forward to working with you. As Ms. Brown said, we have offices in 5 states. We serve the entire country and the territories as well. So we do look forward to working with you and your organization and communities.